A growing number of UK citizens may soon feel the unexpected impact of a government error that could cost them hundreds of pounds every year in retirement benefits. The issue, which centres around a misstep in how national insurance contributions are being handled, particularly affects those who are self-employed. In recent months, several reports have emerged indicating that incorrect refunds for Class 2 national insurance contributions are being processed by HM Revenue and Customs. Although the refunded amount might seem small, currently set at £3.45 per week, the consequences could be much more serious than initially expected. What makes this issue even more concerning is that a simple refund is being interpreted by the HMRC system as a complete lack of contribution for that year. This means that even though individuals might have paid their dues in good faith, their official record now shows a gap in their national insurance history, potentially leading to a significant reduction in the amount of state pension they receive later in life. This oversight has triggered concern among financial planners and personal finance experts, who warn that many affected individuals might not even realise what's happened until it's too late. For example, having just 1 year of missing contributions could lower someone's annual pension by about £342. Over the course of a 20-year retirement, this adds up to nearly £7,000 in lost income, enough to cover essential bills, home maintenance, or even travel plans in retirement. And the scariest part? The problem lies in the background, quietly reducing future pension payments without triggering any immediate red flags. Since the flat-rate Class 2 NICs are often paid voluntarily by self-employed people running small businesses or working freelance, the relatively low value of the payments can make them easy to overlook. A refunded amount might seem like a small bonus or correction at first glance, but it could actually signal a much larger issue for one's financial future. The way the new state pension works is based on your national insurance record. Since the government reformed the system in April 2016, people need 35 qualifying years of national insurance contributions to get the full new state pension. If someone has fewer than that, their pension will be reduced accordingly. Before the changes, the system was more complex, with varying eligibility requirements, but today's structure has simplified the rules, although it still requires individuals to be vigilant about their contribution history. While many people will have some contributions from before the 2016 cut-off, either through employment or credited periods such as time spent on maternity leave or receiving certain benefits, others, especially younger self-employed workers or those who took career breaks, may find themselves falling short. Financial advisors are urging workers, particularly the self-employed, to regularly check their national insurance records through the official government portals. By doing so, people can identify any gaps or discrepancies in their records and take action to correct them. However, navigating these systems isn't always straightforward. The HMRC interface isn't always user-friendly, and interpreting what counts as a qualifying year can be confusing. Ross Lacey, a director and financial planner at Fairview, highlighted the problem in a recent interview, pointing out that many small business owners don't realize the long-term impact of missing or refunded contributions. He noted that while Class 2 NICs are inexpensive and might not seem like a priority, they serve a critical role in securing eligibility for various state benefits, not just the pension. These include certain forms of maternity allowance, the bereavement support payment, and the new style job seekers allowance. Lacey also mentioned that it's becoming increasingly difficult for individuals to find clear, reliable advice on their exact national insurance position. The complexity of the tax system, combined with the government's digital-only approach to communication, has created confusion and, in some cases, unintentional non-compliance. This is particularly true for self-employed individuals who are new to managing their own taxes and benefits. With HMRC systems still catching up and adjusting to recent rule changes, the likelihood of automated errors remains high. Unfortunately, these aren't just technical glitches, they have real, long-term financial consequences. In light of the situation, HMRC has acknowledged the mistake and issued a public apology, stating that they are working to identify and correct the affected accounts. While this is reassuring, the process may take time, and affected individuals are advised not to wait for HMRC to act first. Instead, they should be proactive, logging into their personal government gateway account to review their national insurance record, identify any refunded contributions, and determine whether their qualifying years are being correctly counted. In some cases, individuals may be able to pay voluntary contributions to cover gaps, but the process isn't automatic. They'll need to contact HMRC directly, request a full breakdown of their contribution history, and in some cases, provide evidence that they had actually paid the Class 2 NICs that were refunded in error. The system does allow for back payments to be made, but there's a time limit, and the cost may vary depending on how many years are missing and whether those years fall within certain eligibility windows. This is why catching the issue early is so crucial. The situation also shines a spotlight on the broader issue of retirement planning in the UK. Many people, especially younger workers and those in non-traditional employment, underestimate the importance of tracking their state pension entitlements. While private pensions and workplace schemes provide additional support, the state pension remains the cornerstone of retirement income for millions of people. Losing even a small portion of it can significantly affect long-term financial stability. With the cost of living continuing to rise, and many retirees relying heavily on fixed incomes, every pound counts. As such, individuals are being urged not only to check their own records but also to speak to friends, family members, and colleagues who might be unaware of the issue. The more people who catch and correct these errors early, the less damaging the consequences will be in the future. HMRC has stressed that it is prioritizing the correction of affected accounts and will reach out to individuals once their cases have been reviewed. However, due to the scale of the issue and the manual work involved in verifying each account, this process may take months. In the meantime, financial advisors recommend keeping detailed records of any communication with HMRC, saving proof of payments, and following up if there's no response. Many self-employed individuals have praised the government's push towards digital tax systems, but this situation shows that automation isn't foolproof. When payments are automatically refunded without context and without clear explanation, the system risks undermining the financial security of those it's meant to support. Overall, this unexpected pension issue serves as a critical reminder of the importance of staying informed and actively managing one's financial affairs. The people most at risk are those who've paid voluntarily, without being formally required to, and who now face unintended penalties due to system errors. As the retirement landscape continues to evolve, particularly with an aging population and increased reliance on self-employment, the need for transparent, accessible, and accurate financial information has never been greater. If you're unsure about your status, now is the time to act. Check your national insurance record, speak to a qualified advisor if needed, and don't assume everything is correct just because you received a refund. A small oversight today could mean thousands lost tomorrow. With awareness and action, the damage can be limited, but it starts with knowing where you stand.